Welcome, curious minds, to another deep dive.
Glad to be here.
Today, we're taking a deep plunge into the fascinating and, let's be honest, a little unsettling waters of the U.S. equity market. Specifically, we're looking at the run-up to August 21, 2025.
Right.
Now, this wasn't just any day. It actually marked a 5-day losing streak for stocks.
Yeah, pretty noticeable slide.
It felt like this methodical pullback that has everyone from seasoned Wall Street pros to individual investors, well, like you, asking, what exactly is going on, and why does it feel kind of different this time?
It's definitely a complex period. I'd call it a recalibration for the market. Investors are really rethinking almost every expectation they've held throughout the summer months.
Rethinking how?
Well, we're seeing a fundamental reassessment of risk, and it seems to be largely driven by two incredibly powerful forces.
Okay, what are they?
First, there's the looming Jackson Hole Economic Symposium. Everyone's hanging on Chair Powell's highly anticipated address there.
Yes. Jackson Hole, always a big one.
Always. And second, there's this relentless drumbeat of persistent inflationary signals. Just seems to keep popping up.
So inflation worries haven't gone away.
Not at all. And these two factors, they're interwoven, really. They're acting as the primary drivers of this uncertainty and the resulting cautious market behavior we've been seeing.
And that's precisely what we're here to do today. Try and unearth the underlying causes of this market anxiety. We're going to pull back the curtain on everything from those huge overarching macroeconomic signals all the way down to the nitty-gritty of individual corporate performance. Our mission, really, is to give you, our well-informed learner, the most important nuggets of knowledge and insight. We've got a stack of diverse sources here.
Yeah, lots to sift through.
We want to help you connect the dots and understand what this truly means for your own financial landscape. We'll be digging through intricate reports, cutting-edge analyses, raw data, basically trying to bring you some clarity.
Okay.
Sounds good. Let's do it. All right, let's unpack this. So, to really get a handle on this week, let's cast our minds back to August 20th, 2025. A Thursday.
Right, the end of that 5-day slide.
Exactly. The 5th consecutive session of declines for U.S. equity markets. Now, importantly, this wasn't some sudden dramatic crash, was it? No single Black Monday moment.
No, not at all. It felt different. More like what many analysts described as a methodical pullback.
Methodical.
Yeah, it felt more like a slow, kind of deliberate unwinding, not a panicked scramble for the exits.
So what was fueling this methodical retreat?
It seems to be a confluence, a real coming together of broad macroeconomic anxiety, and alongside that, some rather specific corporate disappointments.
Okay.
Those really soured investor sentiment during the week.
Okay.
What we really observed was a distinct risk-off posture taking hold across portfolios.
Risk off. Can you break that down for our listeners? What does that mean for the average investor watching this?
Sure. Basically, it means a strategic shift. Investors are moving away from high-growth, high-valuation stocks. The ones that had been the darlings of the recent rallies.
The tech darlings, maybe.
Often, yeah. And they're deliberately moving into what are considered more defensive sectors.
Defensive. Like utilities, staples.
Exactly. Think of it as institutional money moving from those more speculative ventures companies promising huge future growth way out there towards safer, more stable havens, companies that typically perform okay even when the broader economy faces headwinds.
Right. Steady eddies.
Sort of, yeah. Less exciting, maybe, but perceived as safer right now.
And we can see this playing out very clearly in the numbers and the performance of the key indices. They're like the market's vital signs, right?
Absolutely. They tell the story.
Okay, so the S&P 500, the big one, the broad market benchmark, 500 largest U.S. companies, it slipped by 25.61 points. That's 0.4%. Closed at 6,370.17.
Now, 0.4% on its own maybe doesn't sound like a disaster.
Nope.
But the context is key. This particular decline marked its longest losing streak of the year, a full 5-day downturn.
5 days. That gets people's attention.
It does. It's a significant psychological shift for traders. And what's more, it put the index about 1% below its recent all-time highs that were set just the previous week.
So a quick reversal from the top.
Yeah, a very quick reversal. And here's where it gets technically interesting for the chart watchers out there.
Okay.
The S&P 500 actually breached its 20-day moving average.
The moving average. Explain that quickly.
Sure. It's basically a continuously updated average price for, say, an index over the last 20 trading days. It acts as a kind of technical support or resistance level. Analysts watch these, hawks.
So breaking below it is bad.
Generally, yeah.
Yeah.
When the price dips below that 20-day moving average, especially after a strong run-up like we had, it's often seen as a technical signal, a sign that the short-term bullish momentum might be breaking down.
The bulls are losing steam.
Exactly. It tells us the bulls, those betting on higher prices, might be losing their grip, and the bears, who expect lower prices, are starting to test the waters. This particular breach, just below 6,380 on the S&P, suggested a potential shift in the market's immediate trend.
Okay, so the S&P was under pressure. Was it just that broad index, or were others feeling it too?
Oh, not at all. It was pretty widespread. The Dow Jones Industrial Average, the blue chip benchmark, 30 big U.S. companies, that also declined, down 152.81 points, which was about 0.3%, closing at 44,785.50. Interestingly, the Dow felt a kind of disproportionate impact from one specific corporate earnings report. We'll dig into that company later, but
Let me guess. Walmart.
you got it. Walmart's significant decline really pulled the Dow down, which just highlights how concentrated that index can be sometimes. One stock can really move it.
Right. And then there's the NASDAQ, home to so many of those high-growth tech and AI names that have led the charge for so long. How did it fare?
Also down. The Nasdaq Composite dropped 72.55 points, also 0.3%, finishing at 21,100.31. And what's really telling is that this tech-heavy index is now on pace for its worst weekly performance since May.
Since May. Okay, that suggests something's accelerating.
It really does. It indicates that the profit-taking and this rotation out of the tech sector are actually picking up steam.
Profit-taking makes sense after the run they've had.
Absolutely. And the more concentrated Nasdaq 100, which tracks the biggest non-financial companies on the exchange, that's now down nearly 3% from the all-time high it set just last Wednesday.
Wow, 3% in just over a week for the leaders.
Yeah, it highlights the acute pressure specifically on those mega-cap technology stocks. It really suggests investors are saying, okay, great run, time to lock in some gains.
You've called this a methodical pullback, not a crash.
Yeah.
But look, for many people watching their own accounts, a 5-day slide, it can feel like panic is setting in.
Oh, absolutely. I get that. The optics, the red numbers day after day can be unnerving.
So what's the fundamental difference? What's actually driving this kind of behavior versus, say, an all-out market rout?
That's a really crucial distinction to make. A crash is typically characterized by, forced selling, margin calls hitting, a complete breakdown of confidence, often triggered by some unexpected severe shock. Think 2008 or the COVID crash initially.
Yeah, sudden and sharp.
Exactly. What we observed here feels quite different. This looks more like strategic repositioning by the big players, the institutional investors.
Okay, strategic repositioning. Meaning what exactly?
They're confronting what feels like a wall of uncertainty, a massive barrier of unknowns, and it's centered squarely on the Federal Reserve's policy path. Where are interest rates going?
The million-dollar question. Or trillion-dollar, maybe.
Probably. Remember, the market had built up this really strong conviction, especially earlier in the summer, that interest rate cuts were imminent. It was almost a consensus belief that the Fed would soon pivot to monetary easing.
Yeah, that narrative was everywhere. Pivot was the word.
It was. But then you get the Fed's own July meeting minutes. And they revealed a committee far more concerned about persistent inflation risks than they seem to be about a slowing labor market.
So the Fed wasn't quite singing the same tune as the market wanted?
Not really. Combine that cautious tone from the Fed with these emerging inflation signals from recent economic reports. Well, that prior conviction about imminent rate cuts has been deeply challenged, seriously undermined.
Okay, so investors are getting nervous about the Fed staying tougher for longer.
Precisely. So what do? They incrementally trim their exposure, they lock in some profits from the big run-up, and they deliberately lower their portfolio volatility before what is essentially a major known event catalyst.
Which is Powell's speech at Jackson Hole.
Exactly. Think of it like a highly anticipated movie premiere. Everyone knows the date. Everyone's waiting for the first reviews to drop before they commit to buying their tickets, right?
Yeah, nobody wants to buy a ticket for a flop.
Right. No one wants to be caught flat-footed if the reviews are bad, if Powell sounds hawkish and the market takes a sudden dive. So this methodical, multi-day bleed we've seen, it's less about forced liquidation and much more about prudent preparation, adjusting the sails before a known potential storm arrives.
Okay, that analogy helps.
Yeah.
So for you, watching your own portfolio right now, the key insight here seems to be that during these periods of heightened uncertainty, the big tide of macroeconomics, it can literally lift or sink all boats, regardless of how well an individual company might seem to be doing. It forces us, really, to look beyond just the single stock headlines and understand these larger underlying currents that are moving everything.
That's a perfect way to put it. The macro environment is just dominant right now.
So with that backdrop of broad market uncertainty, this strategic repositioning happening, it really sounds like everyone's just holding their breath for one specific event. Is that fair to say?
Oh, absolutely, 100%. The market is, well, it's entirely fixated on the Federal Reserve's annual economic symposium in Jackson Hole, Wyoming.
That gathering in the mountains.
That's the one. Central bankers, finance ministers, academics, top financial market players, they all gather to discuss these big long-term policy issues.
But really, it boils down to one speech, doesn't it?
Pretty much. The undisputed highlight of the whole event is Chair Jerome Powell's keynote address. It is widely seen as a pivotal moment for monetary policy direction.
Pivotal. For the rest of the year, you mean?
For the rest of the year and well into next year, potentially. The anticipation alone has created this palpable tension across all markets. You can almost feel it.
And you can measure it too, right? With things like the VIX.
Exactly. You can see this tension reflected very clearly in what we call the market's fear gauge, the CBOE Volatility Index, or VIX.
The VIX, okay.
This index basically measures the market's expectation of future volatility based on S&P 500 options prices. How much movement are traders betting on?
So what did it do on Thursday?
On August 21st, it climbed. It went up by 5.1% to 16.49. Now, that level itself isn't extreme panic, but the increase signals a rising cost for portfolio hedging.
Hedging. Like buying insurance.
Essentially, yes. Traders were paying more to protect their positions, bracing for potential turmoil. It implies they expect a bigger than usual move coming soon.
Interesting.
And the options market illustrated this heightened anxiety even further. The pricing in the options market suggested that investors were expecting an S&P 500 move of about 0.8% in either direction by the end of the week.
0.8%. How does that compare normally?
Well, that's nearly double the average daily move we'd seen over the past month.
Wow. So the market was pricing in a big reaction to Powell's speech.
A very big reaction. It tells you just how much uncertainty and potential for a significant market swing was baked in.
And this isn't just about one speech, is it? It feels like we're watching something bigger, like a fundamental shift in how the market views the Fed's intentions. It's almost like a pivot before Powell even speaks.
You're hitting on the absolute core of it right there. We are witnessing a significant recalibration of interest rate expectations.
Recalibration, okay.
Remember, that entire summer rally, the one that propelled stocks to new highs, it was built almost entirely on an imminent monetary easing narrative.
Right, the rate cuts are coming soon story.
Exactly. The market largely believed the Fed would soon begin cutting interest rates, maybe as early as September, maybe December. That conviction, however, has been profoundly eroded over the last couple of weeks.
How can we see that erosion?
Look at the rate cut probabilities for September. These are implied by trading in federal funds futures derivatives that let traders bet on where the Fed's key interest rate will be.
Okay, what do they show?
Just a week before this, the probability of a September rate cut was sitting above 90%. Pretty much a done deal in the market's eyes.
Wow, okay.
By August 21st, where were we? It had fallen dramatically, down to a range of somewhere between 72% and 79%.
That's a huge drop in probability in just 1 week.
A massive shift in expectations in a very short period.
So what caused such dramatic shifts? Why did the market lose face in those imminent cuts?
Well, the reasons for this shift are pretty clear and directly linked to a couple of things. First, as I mentioned, the Fed's own July meeting minutes.
The ones that sounded more worried about inflation.
Precisely. They revealed the committee was far more concerned about persistent inflation risks than maybe the market had appreciated. Many members still saw inflation risks tilted to the upside, meaning they thought inflation was more likely to surprise by being higher, not lower.
Okay, so the Fed's own words were a wake-up call.
They were. And then second, we had a stream of recent economic reports that pointed to sticky price pressures across the economy.
Sticky prices.
Yep.
Meaning inflation isn't going away easily.
Exactly. It's proving stubborn. It's not just a temporary blip. So you put those two things together, the Fed's cautious tone and the sticky inflation data and the market's previous story of clear, imminent rate cuts. Well, this doesn't hold up as strongly anymore.
The narrative cracked.
It really did. And what's fascinating, I think, is this has created a kind of narrative vacuum in the market.
A narrative vacuum? What do you mean?
Well, without a clear, strong, fundamental driver pushing stocks higher on its own, like the promise of rate cuts was doing all the market's attention, just collapses onto the single individual who can provide the next directional theme.
Ow.
Powell. His speech isn't just another data point in this environment. It's seen as the potential source of the market's next major trend, the thing that fills the vacuum. That's why we saw that cautious wait-and-see approach dominate trading leading up to it. Nobody wanted to make a big bet before hearing from him.
So for you, the listener, this isn't just some abstract economic debate. It's a really vivid illustration of how these global financial narratives, the whispers, the hints, the official pronouncements from central bankers, how they can directly and powerfully influence the value of your investments, even before any actual policy changes happen. It's all about perception shaping reality in the markets right now.
Perception is absolutely key in moments like these.
Okay, so the market's overall mood was clearly cautious, nervous even, and expectations about the Fed were definitely shifting, becoming less optimistic about rate cuts.
Right, but was this caution felt equally across the board? Or did we see some parts of the market bearing the brunt, while others, maybe surprisingly, found some resilience?
That's an excellent question, because no, the market's caution wasn't uniform at all. We actually saw a really stark and accelerating rotation among the S&P 500's 11 sectors.
Sector rotation. Okay, so money moving between different industries.
Exactly. What that means is investors were actively shedding exposure to growth-oriented segments, basically selling stocks that tend to thrive when the economy is expanding rapidly, and they were seeking refuge in defensive areas, those sectors that typically hold up better during economic uncertainty or slowdowns.
Got it. Selling growth, buying defense.
Precisely. And this defensive leadership trend, which had kind of been gradually building throughout the week, was firmly established on Thursday, August 21st. Even as the broader S&P 500 index declined overall, sectors known for their stable cash flows and lower sensitivity to economic cycles, they actually significantly outperformed.
Like which ones specifically? Well, energy, for example. The Energy Select Sector SPDR Fund, ticker XLE, it climbed 0.80%.
Energy was up. Interesting.
Yeah. And consumer staples, ticker XLP, think food, beverages, household products, it gained 0.60%. And healthcare, XLV, that rose 0.50%.
Staples and healthcare make sense as defensives. People still need food and medicine.
Absolutely. These sectors provided real pockets of strength because they tend to be less affected by economic downturns. Demand is relatively stable regardless of interest rates or GDP growth. We also saw real estate and utilities benefiting from this flight to safety, partly because they often offer stable dividends and have that predictable demand profile.
Okay, so energy, staples, healthcare, utilities, real estate. They were the relative winners. Who were the losers in this rotation?
Well, on the flip side, the sectors that are much more closely tied to economic growth and are notoriously sensitive to interest rates faced the heaviest selling pressure.
Like tech again.
Tech, yes, and also consumer discretionary. That's the XLY ticker. It includes companies selling non-essential goods and services, think cars, luxury items, travel, restaurants. That sector was among the worst performers, continuing a decline from the previous day.
Makes sense. People cut back on non-essentials first when times get tough, where borrowing costs rise.
Exactly. And the information technology sector, XLK, which, as we discussed, was the engine of the market's rally earlier in the year, fueled by all that AI enthusiasm, it remained under significant pressure. Investors just continued to take profits from those high-flying, sometimes stretched valuations, especially given the growing concerns about interest rates staying higher for longer.
Okay, this rotation makes intuitive sense, but let's dig into the why a bit more. Why are these specific sectors behaving this way, almost like mirror images of each other? What's the mechanism?
It really comes down to what analysts call a calculated repricing based on duration risk in a rising interest rate environment.
Okay, duration risk. That sounds like a bond term. How does it apply to stocks?
That's a great point. It originates in bonds, but the concept is very applicable to stocks too. Let's break it down because it's critical here. When we talk about duration risk in stocks, we're thinking about how sensitive a company's valuation is to changes in interest rates.
Okay.
And the rise in the so-called risk-free rate specifically, the yield on the 10-year Treasury note acts as the primary transmission mechanism for this rotation. It's the key channel.
The 10-year yield. That hit 4.329% on August 21st, you said.
That's right. And that yield is often used by analysts as a benchmark discount rate when they try to figure out the present value of a company's future cash flows.
Discount rate? Like how much future money is worth today?
Exactly. And when that rate goes up, it directly impacts how we value a company's future earnings. Think of it this way. A higher discount rate disproportionately hurts growth stocks. Why? Because their valuations depend very heavily on earnings projected far into the future.
Right. Tech companies promising huge profits years from now.
Precisely. If a company is expected to earn most of its profits 5, 10, even 20 years down the line, and the cost of money, the interest rate goes up today, those distant future earnings get discounted much more steeply. It makes the stock less valuable right now in today's dollars.
Even if the company itself is doing well.
Even if the company's underlying business is still booming, the math just changes. This higher discount rate prompts a sell-off in these longer duration assets, challenging that simple instinct to just buy good companies. It forces a harder look at when those earnings are actually expected to arrive.
Okay, that makes sense for growth stocks being sensitive. How does it explain the appeal of defensive stocks then?
Well, contrast that with defensive sectors like consumer staples or healthcare. They tend to offer more predictable near-term cash flows. People buy toothpaste this quarter, not 10 years from now.
Right, near-term earnings.
Exactly, and they often come with higher dividend yields as well. Because their earnings are more immediate and less reliant on that distant projected growth, they are inherently less sensitive to changes in the discount rate. Their duration is shorter, so to speak.
Oh, I see.
So when bond yields are rising, the stable income and the less speculative nature of these defensive businesses become relatively more attractive. The flow of capital out of tech and consumer discretionary and into staples, healthcare, and energy is, in essence, a logical and mechanical repricing of the market based on those clear signals coming from the bond market.
So it's not just fear, it's math.
A lot of it is math. What's fascinating here is how this flight to safety isn't purely emotional panic. It reflects a logical, almost mechanical repricing based on clear signals from the bond market. It's investors adapting quite rationally to a potential higher for longer interest rate scenario.
Higher for longer. That phrase keeps coming up.
Because it's the core theme right now. Investors are adjusting to the possibility that borrowing costs might stay elevated for an extended period. Think of it like adjusting your car's suspension. You've been driving on a perfectly smooth highway, and then suddenly you hit a stretch of really bumpy roads. You quickly realize your previous settings just aren't going to cut it anymore. You need to adapt.
That's a great analogy. So for you, the listener, this is really crucial insight into how different parts of the economy react to these shifting interest rate expectations. Understanding this duration risk concept directly informs your own understanding of why certain sectors perform the way they do, even against a broad market trend. And maybe it helps you assess your own portfolio's sector weightings too. Are you perhaps overly exposed to that long duration growth? Or have you built in some of that defensive ballast for potentially bumpier roads ahead?
Exactly. It's about understanding the different sensitivities within your portfolio.
Okay, let's shift our focus now. We've talked about the big picture, the Fed fixation, the sector rotation. Let's drill down now to individual corporate earnings reports and those news headlines that pop up.
Right, the micro level.
Yeah, because these aren't just isolated stories, are they?
Yeah.
They seem to be creating significant pockets of volatility on their own, but also, importantly, offering clues about that bigger picture we've been discussing.
That's exactly right. It's clear the market is scrutinizing these results extremely closely right now. Not just looking at the headline numbers, did they beat or miss revenue and earnings estimates.
What else are they looking for?
They're digging deeper, searching for hidden messages, for clues about inflation trends, about how consumers are actually behaving, and about how resilient company profit margins truly are in this environment. Can companies pass on higher costs or not?
Margin resilience. That sounds key.
It is. These company-specific stories provide a really granular, real-world view of the macroeconomic pressures that are impacting actual businesses. They offer a kind of micro-level confirmation, or sometimes contradiction, of the macro themes we've been talking about.
Okay, so let's look at some key players from that Thursday, August 21st. You mentioned Walmart earlier.
Yes, let's start there. Walmart's warning shot on profitability. WMT. The retail giant announced its second quarter results, and they really presented a mixed but ultimately quite worrying picture for the market.
Mixed how?
Well, on the one hand, their revenue was strong, up nearly 5% year over year to $177.4 billion. That actually beat the consensus estimates. And their U.S. comparable sales at stores open for at least a year, a key retail metric, were also strong, rising 4.3%. So people were still shopping at Walmart.
And so far, so good. But there's a but.
There's a crucial but. Adjusted earnings per share came in at $1.68. That fell short of the $1.73 analysts had been expecting.
Ah, the profit miss.
Exactly, and that profit miss sent Walmart shares down a notable 4.5%. As we said, it was one of the heaviest weights on both the Dow and the S&P 500 that day.
So why is that profit miss so significant? Sales were good.
The significance is profound, really. This divergence between strong top-line sales and weaker-than-expected profitability points directly to margin compression.
Margin compression.
Yeah,
Meaning their profit margins are shrinking.
precisely. In simpler terms, Walmart, a bellwether for the entire U.S. consumer economy, a company known for being a master of supply chain efficiency, seems to be struggling to fully pass on its own rising input costs.
It's like what?
Things like freight, transportation, labor costs, and potentially, this was mentioned, costs exacerbated by recent tariffs. They seem unable to pass all of that on to their famously price-sensitive customers without taking a hit to their own bottom line.
Wow. If Walmart can't pass on costs easily.
Exactly. If they can't fully pass on these costs without hitting their profits, what does that say about inflation's real grip on every other business out there, especially smaller ones?
Yeah, that's a worrying signal.
For a market already on high alert for persistent inflation, this was seen as a significant red flag. It provided tangible, real-world evidence of the exact inflationary pressures that could force the Federal Reserve to maintain a more hawkish policy stance.
So it directly feeds back into that Jackson Hole narrative.
Directly. This wasn't just a single company missing earnings. It was perceived as a loud, clear signal about the broader economic landscape and the ongoing, difficult struggle against inflation.
Wow. Okay, so a single company's struggles with passing on costs can actually tell us something that fundamental about the entire inflation picture. That's really quite fascinating.
It absolutely can, especially when it's a company with the sheer size and reach of Walmart. It's a window into the real economy.
Were there other earnings reports sending similar signals?
There were. Another notable one was Coty, C-O-T-Y. That's the beauty products company. They own brands like CoverGirl, Max Factor, Calvin Klein fragrances.
Right.
Their stock absolutely plummeted down a staggering 21.6% in one day.
21%.
Yeah.
What happened?
They reported a wider-than-expected adjusted quarterly loss. And importantly, in their commentary, Coty explicitly cited broader macroeconomic and tariff uncertainty as reasons for cautious ordering from their retail partners.
Ah, so retailers were pulling back orders because of the uncertainty.
Seems like it. This just further reinforced that theme of macro headwinds directly impacting corporate performance, particularly for consumer-facing businesses dealing with discretionary or non-essential spending.
It wasn't all bad news on the earnings front, though, was it?
No, definitely not. We had a positive counter-narrative from Nordson, NDSN. They're an industrial manufacturing firm making things like precision dispensing equipment.
Okay.
Their shares climbed nearly 5% after delivering quarterly profit and revenue that actually surpassed analysts' expectations.
So some companies are navigating this okay.
It shows that strong operational execution and perhaps leadership in a specific niche market can still be rewarded by investors, even in a generally challenging macro environment. Good management matters.
And beyond the actual earnings numbers, we had some key corporate headlines moving stocks, too. Almost like mini earthquakes affecting just one part of the market.
Exactly. Headlines still matter a lot day to day. For example, Boeing, BA shares, rose more than 1%. Why? On reports that it's in discussions to sell as many as 500 airplanes to China.
500 planes, it's huge.
Potentially huge, yes. It highlights the continued sensitivity of these large multinational industrial companies to developments in international trade relations and geopolitical events. Good news on trade with a major economy like China can provide a significant boost, even if it's just talk at this stage.
Interesting. Any other significant headlines?
Well, Meta Platforms, Meta, the parent company of Facebook and Instagram, faced some pressure.
Why Meta?
The Wall Street Journal reported that the company had frozen hiring in its artificial intelligence unit.
Frozen AI hiring. That seems counterintuitive given the AI boom.
It does, but the context was that this followed a massive spending spree to attract top AI talent. And that spending raised analyst concerns about soaring stock-based compensation costs and their potential threat to shareholder returns.
The cost of the AI race.
Exactly. It added a bit to the negative sentiment surrounding some big tech valuations. It was a reminder for the market that even the biggest, most dominant tech companies face pressure to manage costs effectively and deliver profits back to shareholders, not just chase growth at any price.
So what does this mix of corporate news mean for you, the listener?
Well, I think it clearly shows how these individual company stories, especially those of retail giants like Walmart, provide really crucial real-world insights into the broader economy and that ongoing inflation battle.
It makes the macro trends feel more real.
Very tangible, yes. It offers a ground-level view that complements, and sometimes challenges, the broader economic data we get. And it highlights how, beneath those big macro trends, these idiosyncratic factors, things related to fundamental news for a specific company, corporate actions like mergers or hiring freezes, even speculative interests that continue to offer both opportunities and risks for investors.
So even when the tide is going out, some
Yeah.
individual boats might be sailing fine or sinking faster.
That's a good way to think about it. You always need to look under the surface.
Okay, let's zoom in even further now on some of those specific stocks that saw really dramatic moves on Thursday. You mentioned this bifurcation in the market earlier,
Yes, the split.
where despite the broader negative trend, individual names can really buck that trend, either up or down, based on their own unique stories and catalysts.
Exactly. This bifurcation tells us that while those big macro factors like the Fed and inflation are definitely dominant right now, company-specific news still drives significant price action. It's the micro-level volatility playing out within the larger macro trend.
Okay, so let's detail some of the top gainers first. What drove them, and what does it tell us?
All right, leading the pack, we had Paramount, Skydance, PSKY. This is the newly merged media entity. It surged an incredible 14.7% on the day.
14%. What was the catalyst there?
It seems to be continued investor optimism after its big merger with Skydance Media went through, but most significantly, the market was really buzzing about a landmark deal they announced, a $7.7 billion deal to secure exclusive U.S. streaming rights for UFC events starting in 2026.
UFC rights. That's huge for streaming content.
It's seen as a potential game changer for the company. It fundamentally alters their content library, brings in a massive, passionate audience, and creates a substantial new, hopefully predictable revenue stream that really diversifies them away from the struggles of traditional media.
Makes sense why the stock would jump.
Absolutely. And the stock's move might have also been amplified a bit by what some analysts describe as meme stock dynamics.
Oh, so?
Well, it reportedly has relatively high short interest, meaning lots of people betting against it, and a relatively small public float, the number of shares available for trading. When good news hits a stock like that, it can sometimes lead to outsized price swings as shorts cover and momentum traders jump in. But the core driver was that UFC deal, a classic example of how a major strategic content acquisition can immediately re-rate a company's prospects in investors' eyes.
Okay, Paramount, Skydance. Who else saw significant gains?
Next up, Precigen, PGEM. This is a clinical stage biotechnology firm. It jumped 13.24%.
Biotech often moves on news. What was
A
it?
very clear and powerful fundamental catalyst, the full FDA approval of its therapy called Papzimeos. This was announced just a few days earlier on August 15th for treating certain rare types of cancer.
FDA approval. That's a holy grail for biotech, isn't it?
It really is. This regulatory milestone, which was the culmination of years of research and development and followed a series of positive clinical trial announcements, just created strong upward momentum for the stock. It validates the company's science, its clinical pipeline, and crucially, opens the door to actually selling the drug and generating revenue. It significantly de-risks the investment case.
Makes sense.
Huh.
Any others jumping out?
Well, then we had Open Door Technologies, Open, the online real estate platform, the iBuyer. That rallied 11.65%.
Open Door. That stock has been all over the place, hasn't it?
Exceptionally volatile, yes. It's a prime example of what we call a high beta speculative asset, meaning it's highly sensitive to overall market sentiment and can swing much more dramatically than the broader indices.
So why was it up so much on a down day for the market?
Well, it seems caught in this constant tug of war. On one side, you have speculative meme rally momentum, where retail investors sometimes pile in. On the other, you have fundamental concerns about its business model, especially in a high interest rate environment, which typically hurts the real estate market.
Right. Higher mortgage rates aren't good for home buying.
Definitely not. So the gain on Thursday appeared to be mostly a technical rebound from some recent selling pressure. That selling had followed a massive surge earlier in the month. Its trajectory has also been influenced recently by a CEO resignation and ongoing efforts just to maintain its NASDAQ listing requirements. So its movement reflects a mix of market sentiment, technical factors, and very specific company drama. Highly speculative.
Okay. Any others on the upside?
Yes, another notable gainer was XPeng, XPEV, the Chinese electric vehicle maker. It climbed 11.63%.
More EV strength. What drove XPeng?
This seemed to be a continuation of positive sentiment carrying over from its strong second quarter earnings report, which they released the prior day. Investors were apparently quite impressed by a notable recovery in the company's vehicle margin.
Vehicle margin. So they're making more profit per car?
Exactly, which is crucial in the hyper-competitive EV market. They achieved this through effective cost-cutting initiatives and also delivering a larger volume of vehicles. It signaled improving operational efficiency and perhaps a stronger financial footing ahead. Margin improvement is always a huge positive for automakers.
Got it. And Nordson, you mentioned earlier.
Right, and we can't forget Nordson, NDSN, which we touched on in the earnings section. Just to reiterate, it had a solid 5.26% gain, driven purely by beating those earnings expectations, thanks to strong operational execution. Shows fundamentals can still win out.
Okay, so a mix of catalysts on the upside. Big deals, approvals, technical bounces, earnings beats. Now let's flip the coin. The notable losers. These often provide just as much insight, don't they? They tell us where the market is finding significant cracks or concerns.
They absolutely do. The losers list can be very informative, starting with the biggest decliner we already discussed, Coty, C-O-T-Y. It plunged that massive 21.43%.
And the catalyst there was clearly
The disappointing quarterly earnings report, the wider-than-expected loss and that very cautious outlook, blaming tariff uncertainty and a tough, highly promotional retail environment. This kind of steep drop often reflects a complete, sudden repricing of future expectations by the market based on a disappointing fundamental picture. Investors just reset their outlook downwards sharply.
Okay. Who else was down significantly?
Then there was Novavax, NVAX, the vaccine maker. Its shares fell 12.7%.
Novavax. Why the drop there? More vaccine news?
No, this was financial engineering. The decline was a direct result of the company announcing that morning a convertible debt refinancing plan.
Convertible debt. Sounds complicated. Why does that hurt the stock?
Well, such financial maneuvers, where a company issues debt that can later be converted into equity or stock, they often raise immediate concerns among existing equity investors about potential future dilution of their holdings.
Dilution, meaning their slice of the pie gets smaller.
Exactly. If more shares might be issued down the road to pay off this debt, then each existing share represents a smaller percentage of the company. This typically leads to immediate selling pressure as investors preemptively adjust for that future possibility. It's a very common, almost knee-jerk negative reaction in the stock market to these types of financing announcements.
Got it. Dilution fears. And the last big loser we should mention again.
And finally, a name we've already highlighted but bears repeating due to its significance. Walmart, WMT. Its shares declined by 3.07%, according to most sources, though some reported closer to 4.5%. And this was, as we discussed at length, driven by that Q2 profit miss and the clear signal of margin compression despite strong revenue growth. A real warning sign for the broader economy.
Right. So these examples really show how, even amidst a broader market trend in this case, a pullback company-specific news, whether it's a huge deal, an FDA approval, a financing plan, or a disappointing financial report, can totally override everything else for that particular stock and drive dramatic price movements both up and down.
Absolutely.
So for you, the listener, this segment really illustrates how, even in a generally down market, specific company news can create significant opportunities or significant risks. It reinforces the need for detailed analysis that goes beyond just the headlines of the major indices. It's about recognizing that every single stock has its own story unfolding, regardless of the overall market narrative at that moment.
Well said. You have to look at both the forest and the individual trees.
Now, it's always vital to remember, isn't it, that the stock market doesn't exist in a vacuum. It's not on its own island.
Not at all. It's deeply interconnected.
It's connected to this vast network of other financial markets, bonds, currencies, commodities, volatility measures. And on August 21st, it felt like these other markets were constantly sending corroborating signals of caution, really reinforcing what we were seeing happen in equities.
That's a crucial point to understand. The interconnectedness of global financial markets is key. Movements in one asset class often confirm or sometimes even amplify trends happening in another. It really is like looking at all the different gauges on a car's dashboard to understand its overall health and maybe figure out what it's likely to do next.
Okay, so let's walk through some of those key signals from other markets on that Thursday.
Yeah.
Where should we start?
Well, let's start with the bond market, specifically Treasury yields ascend. As we touched on, the yield on the benchmark 10-year Treasury note, which is that key global benchmark for borrowing costs and often acts as a risk-free rate against which other investments are measured, it rose 3.3 basis points.
3.3 basis points. A basis point is 1/100%.
Right. So a relatively small move in percentage terms, but directionally important. It closed at 4.329%. And significantly, this marked the largest single-day yield increase in about a week. And it snapped a two-day streak of yields actually falling, so the direction shifted back up.
And what about shorter-term yields?
The more policy-sensitive two-year Treasury note yield also climbed, moving up to 3.78%.
Okay, so yields were rising across the curve. What was the why behind that move?
It seemed to be a direct and immediate reaction to that S&P Global Flash PMI report, the one showing surprisingly strong U.S. business activity.
The strong economic data.
Exactly. Stronger economic growth, especially when combined with signs of rising price pressures within that same report. That causes the bond market to price in a lower probability of near-term rate cuts from the Fed.
Lower chance of cuts means yields go up.
Right. If bond investors think the Fed is going to stay tighter for longer because the economy is strong and inflation is sticky, they demand a higher yield, a higher return for lending their money to the government. So the bond market was basically flashing a signal saying, hey, based on this new data, don't count on those rate cuts quite so fast.
Understood. So the bond market is sending a clear caution. Fed might stay tight, signal that directly impacts stocks. Now, what about energy markets? You mentioned they rallied. How does that fit the caution theme?
Right, the energy markets also rallied. And this flashed further inflationary signals, which adds to the caution. West Texas Intermediate, or WTI, crude oil futures, that's the U.S. benchmark they advanced, settled around $63.40 per barrel, a gain of over 1% on the day.
And Brent crude, the international one.
Similarly, Brent crude rose, trading near $67.43 per barrel.
What was pushing oil prices higher?
The why behind this strength seemed to be supported primarily by a U.S. government report released the previous day that showed a surprisingly large drawdown of 6 million barrels in commercial crude inventories for the week ending August 15th.
A drawdown means less oil in storage.
Exactly. A significant inventory decline like that is typically interpreted as a sign of robust demand, suggesting the economy is consuming a lot of oil right now.
Strong demand usually means a strong economy. Sounds good? No.
It can. But when strong demand combines with rising prices, it adds to those broader concerns about persistent inflation. Higher energy prices can quickly filter through the entire economy, can't they? Impacting transportation costs, manufacturing inputs, consumer heating bills, everything. So rising oil is often seen as an inflationary headwind.
Okay, so bonds up on growth inflation data, oil up on demand inflation fears. What about things like gold or Bitcoin? Where were they pointing?
Right. Let's look at precious metals and digital assets. They provided interesting, though sometimes slightly conflicting signals. Gold traded within a pretty choppy range. Prices were hovering around $3,340 per ounce.
Choppy. Why wasn't it clearly up or down?
Well, gold often faces conflicting drivers in this kind of environment. As a non-yielding asset, meaning it doesn't pay interest or dividends, it typically sees headwinds when treasury yields are rising and the U.S. dollar is strong. Investors can often get a better return elsewhere, like in bonds.
Right, the opportunity cost.
Exactly. However, gold also draws support from its traditional role as a safe haven asset during periods of equity market uncertainty and geopolitical risk. When stocks are volatile like they were, some investors inevitably flock to gold seeking perceived stability, so it gets pulled in two directions.
Okay, so gold was mixed. What about Bitcoin? Usually seen as a risk-on asset.
And Bitcoin provided a much clearer signal of risk aversion. The digital currency continued its recent slide. It fell below $114,000 to trade at levels around $112,200 to $113,320 during the day.
A clear move lower. What does that tell us?
Well, the decline in Bitcoin, which we often call a high beta speculative asset, meaning it's inherently volatile and highly sensitive to overall market mood shifts, is a pretty classic indicator of reduced risk appetite among investors.
So when people get nervous, they sell Bitcoin.
Often, yes. As capital retreats from the most volatile, most speculative corners of the market during times of macroeconomic uncertainty, assets like Bitcoin often feel the brunt. People move towards perceived safety.
Okay. And just to round out the dashboard, the VIX and the dollar.
Right, just to reiterate those quickly, the CBOE Volatility Index, the fear gauge, climbed to 16.49, up 5.1% on the day, clearly showing that increased demand for portfolio hedging, for buying insurance against market drops.
More fear priced in.
Definitely. And finally, the US Dollar Index, DXY, which measures the dollar's strength against a basket of other major currencies, was up about 0.10% to approximately 98.31. A stronger dollar is yet another signal, often, of risk aversion, as global investors tend to flock to the perceived safety and liquidity of the US dollar in times of global uncertainty or stress.
Okay, so if we connect all these dots, treasuries, oil, Bitcoin, VIX, the dollar, what's the bigger picture message from these cross-asset signals?
I think it's a remarkably consistent message across the board. Investors are bracing themselves for something potentially significant from the Federal Reserve at Jackson Hole, and persistent inflation is undoubtedly a key concern driving this widespread caution. It paints a cohesive narrative of de-risking across asset classes, a move away from anything perceived as too risky or too exposed to future policy uncertainty.
So for you, the listener, understanding these cross-asset signals really helps you piece together that broader economic narrative. It truly is like looking at all those different gauges in the car's dashboard, as you said, to understand its overall health and what it might do next, rather than just focusing solely on the speedometer, which is the stock market.
Exactly. They tell a more complete story together.
Okay, this brings us now to perhaps the most significant part of the puzzle, the piece that the Fed itself is grappling with most intensely right now.
The core dilemma.
Right. The dilemma facing the Federal Reserve, and by extension, the reason for the market's heightened state of uncertainty. It seems the economic data itself is painting a really conflicting and complex picture. It makes the Fed's job, and the market's attempt to predict the Fed's moves, incredibly challenging. It's like a genuine fork in the road for them, isn't it?
It absolutely is. That's an excellent way to put it, a fork in the road. We are looking squarely at two opposing narratives emerging simultaneously from the economic data. And importantly, both narratives are supported by fresh, credible evidence released just that week, even that day.
Two opposing stories, both true.
Essentially, yes. And this makes Chair Powell's task in crafting his message for Jackson Hole exceptionally challenging. And it's really the primary source of the market's anxiety, those Jackson Hole jitters, and the cautious positioning we've seen build up.
Okay, so let's lay out these two opposing narratives. Let's start with the first one. The case for holding firm or the hawkish signals. What data supports that?
Well, the most impactful data release of the day, arguably, was the S&P Global Flash PMI for August.
The PMI, again, flash means it's an early estimate, right?
Correct. It's the preliminary reading for the month. PMI, again, stands for Purchasing Managers Index. It's a survey-based indicator that measures the month-to-month change in business activity in the manufacturing and services sectors.
And what did this flash PMI show?
It delivered a significant upside surprise, meaning it came in much, much stronger than economists have been expecting.
Stronger how?
Well, the headline Composite PMI, which blends manufacturing and services to measure overall business activity, rose to 55.4. That indicated the fastest rate of business activity growth so far this year.
Wow, fastest growth this year in August. That doesn't sound like a slowing economy.
Not at all. And both the underlying components were strong, too. The manufacturing PMI came in at 53.3, and the services PMI was at 55.4. Both comfortably beat expectations, and both were firmly in expansionary territory. Remember, any reading above 50 signifies expansion, so levels above 55 are quite robust.
Okay, strong growth. But what about inflation in that report?
And crucially for the Fed, the report contained a very clear inflationary warning. It specifically noted that President Trump's recent tariffs were being cited by businesses as a contributing factor in pushing up average selling prices at the fastest rate in 3 years.
Tariffs pushing up prices.
Right.
Fastest rate in 3 years. That's a direct inflation signal linked to policy.
A very direct link. So you put this all together, the strong growth, the accelerating price pressures, the tariff impact. And this data strongly argues against the need for immediate rate cuts.
Right. It suggests the opposite almost.
It really does. It suggests the U.S. economy remains remarkably robust, showing accelerating growth even, and that underlying inflationary pressures are not only present, but are actually accelerating. If inflation is picking up speed again, the Fed certainly won't be rushing to loosen monetary policy by cutting rates. In fact, some might argue this data could even make a case for another rate hike down the line, though that's not the base case expectation right now.
Okay. So that's a very strong case for the Fed to stay hawkish, to keep rates high, maybe signal they'll stay high for longer. Powerful data.
Very powerful.
But then, as you said, there's the flip side. There's the case for easing, or the dovish signals. What evidence supports the idea that the Fed should actually be thinking about cutting rates?
Right.
It seems like a direct contradiction.
It really does feel like a direct contradiction. But in contrast to the PMI's clear signal of economic strength, data coming from the labor market continued to point towards a gradual but noticeable slowdown.
The jobs market, what do we see there?
Well, the latest weekly jobless claims report came out that morning, too. It showed that initial claims for unemployment benefits, people filing for the first time, rose slightly to 235,000. That was a little bit more than economists had anticipated.
Okay. A small rise in new claims, is that the main thing?
Not necessarily the main thing. Perhaps more concerning for policymakers was the figure for continuing claims. This represents individuals who are already receiving unemployment benefits, meaning they haven't found a new job yet.
Right. How long people stay unemployed.
Exactly. And that number climbed again, hitting a new cycle high of 1.972 million. That's a level we haven't seen since way back in November 2021.
A cycle high in continuing claims. What does that suggest?
Well, rising continuing claims can be interpreted as a leading indicator of a weakening job market. It suggests that unemployed workers are finding it progressively more difficult to secure new positions. If people are staying on unemployment benefits for longer periods, it usually implies either fewer available jobs are out there, or perhaps there's increased competition for the jobs that do exist, or maybe a mismatch in skills.
So a subtle sign of weakness building beneath the surface of the low headline unemployment rate.
Potentially, yes. And this trend of rising continuing claims, when combined with other recent signs of softness, particularly the ongoing weakness we've seen in the housing sector.
Housing has been weak.
Yeah, things like building permits, which are a good forward-looking indicator of construction activity, they've actually declined for 4 consecutive months now. So you take the rising continuing claims and the weak housing data together, and it provides a clear rationale for the Fed to consider cutting rates sooner rather than later to provide some support for a potentially slowing economy.
Right. If the job market is subtly weakening and housing is struggling, that usually argues for monetary policy easing, for rate cuts, to try and stimulate things and prevent a more severe downturn.
That's the traditional playbook, yes.
So, wow. We have robust, accelerating growth and accelerating inflation from the PMI data on one side, and then signs of a weakening labor market, at least in terms of continuing claims, and a struggling housing sector on the other. It truly is, as you said, a real fork in the road for the Fed, isn't it? Which path do they prioritize? Which data matters more right now?
It absolutely is. This data-driven dichotomy places the Federal Reserve at a genuine fork in the road. They are confronted right now with 2 very compelling yet opposing narratives about the state of the U.S. economy. Both narratives, crucially, are supported by fresh, credible economic evidence.
So what are the choices?
Well, one path suggests they should focus on the accelerating growth, and especially the accelerating inflation seen in that PMI data. Following that path would warrant holding interest rates steady for longer, or at least signaling a much slower pace of future rate cuts than the market had hoped for. That's the hawkish path.
Okay. And the other path?
The other path involves prioritizing the forward-looking weakness that's suggested by the rising continuing claims in the labor market and the slump in the housing sector. Following that path would justify an earlier and perhaps more decisive pivot towards monetary easing, towards cutting rates to cushion the economy. That's the dovish path.
And the market has no idea which path Powell will signal.
Because both arguments are currently valid and compelling, based on the data we have right now, it's almost impossible for the market to confidently predict which data set the Fed, and Chair Powell in particular, will weigh more heavily in their upcoming policy calculus and communications. This fundamental uncertainty is the primary source of the Jackson Hole jitters and the cautious market positioning we observed building throughout that week. It's like trying to predict which way a coin will land when it's still spinning high up in the air. Nobody knows for sure until it comes down.
That really underscores it. So for you, the listener, This highlights just how complex the economic landscape is that the Fed has to navigate right now. They're balancing multiple, often contradictory indicators to make these huge decisions that directly impact inflation, jobs, borrowing costs, and ultimately your finances. It's definitely not a simple equation they're working with.
Far from it. It's arguably one of the most complex environments they've faced in years.
Okay, let's try and bring this all together then. The market's behavior leading up to and including Thursday, August 21, 2025. It really feels like it was the culmination of a week-long strategic retreat from risk.
I think that captures it well.
It wasn't that panicked, indiscriminate sell-off we sometimes see. Instead, as you've described it, it felt more like a logical, maybe even necessary, calculated recalibration by investors in the face of mounting uncertainty.
That's right. That really optimistic soft landing narrative, the one that had propelled the summer rally based almost entirely on the expectation of imminent Fed rate cuts, that narrative is now being actively challenged.
Challenged from multiple directions.
Yes, from multiple fronts simultaneously. It's being challenged by the Fed's own cautious rhetoric revealed in those July meeting minutes. It's being challenged by tangible, real-world evidence of inflationary margin pressure coming from economic bellwethers like Walmart. And it's being challenged by surprisingly robust business activity data like that flash PMI, which suggests the fight against inflation might be far from over and the economy might not need rate cuts just yet. All these signals are actively chipping away at that rosy soft landing scenario that the market loved just a few weeks ago.
And this challenge, this erosion of the old narrative, has triggered consequences in the market itself.
Absolutely. This confluence of factors has triggered that necessary and, I would argue, quote, rational rotation within the equity market that we discussed. Capital has clearly flowed out of the most expensive and rate-sensitive sectors, think information technology, consumer discretionary, and flowed into more durable, defensive areas like energy, consumer staples, and healthcare.
And that wasn't just random noise.
Not at all. This isn't merely a shift in sentiments or fleeting fear. It looks like a fundamental repricing of assets based on a higher-for-longer interest rate scenario, now being more seriously considered and priced in by the bond market. Investors are essentially preparing their portfolios for a world where interest rates might not come down as quickly, or perhaps as much as they had previously hoped or assumed.
So where does that leave us right now? For you, the listener, watching all this unfold, it sounds like the market's immediate path, its next significant move, is now almost entirely contingent on the tone and substance of Chair Jerome Powell's address coming up at Jackson Hole. Every word he utters is going to be dissected, isn't it?
Indeed, the stage is set perfectly for it. The conflicting economic data has created such a wide range of potential policy interpretations that it leaves investors with very little choice but to await definitive guidance, or at least strong hints, from the Fed chair himself.
What are the potential outcomes people are bracing for?
Well, broadly speaking, two main scenarios. You could have a dovish Powell. Perhaps he emphasizes the softening labor market signals, maybe downplays the strength or inflationary implications of the latest PMI data. If he sounds dovish, concerned about growth, that could quickly reignite the risk-on rally we saw earlier in the summer. It could send stocks potentially back towards their recent highs as rate cut hopes revive.
Okay, that's the optimistic case. What's the alternative?
The alternative is a hawkish Powell. Perhaps he focuses heavily on the persistent inflationary pressures, maybe highlights the tightness that still exists in parts of the labor market, and signals a need for more patience before considering easing policy. If he sounds hawkish, emphasizing the inflation fight is not over, that could trigger a more significant correction in the markets, validating the cautious positioning we saw building up over the past week, and potentially sending stocks lower as hopes for near-term cuts evaporate further. It really feels like a moment of truth is approaching.
The market has spent 5 days, maybe more, holding its breath, waiting. So here's a final thought for you, our listener, to consider. What will your focus be when Friday's speech from Jackson Hole finally determines the nature of its exhale? Will it be a sigh of relief, fueling a new rally, or will it be a gasp of concern, signaling more turbulence ahead? And perhaps more importantly, what implications might Powell's message have for the broader economic outlook beyond just immediate market sentiment? Think about job growth, consumer spending, the very cost of borrowing money for homes and businesses in the years to come. It's certainly going to be a captivating few days ahead and a true test of which economic narrative prevails.
Absolutely. All eyes are on Jackson Hole.